Welcome to our continuing conversation about Donald Trump's America. I'm Dr. Taji Terrell, professor of fashion and interior merchandising and host of today's podcast. From the time President Trump launched his global trade war, the US stock market has lost over $4 trillion in value. Yet the Republican insists the current economic turmoil is paving the way for America's golden era. Trump contends that by imposing huge tariffs on imports, American and foreign companies will be forced to build production facilities here, thus creating an employment boom. Is Trump right? Will his war on our trading partners, including long-standing allies, restore America's manufacturing might? Will consumers benefit from historically low energy and grocery prices? We'll ask our guests, Dr. A.J. Sumell and Dr. Joseph Palardy, both professor of economics at Youngstown State University. Okay, so welcome, Joe and AJ. Thank you again for joining us today. The last time I saw you guys was when we were hosting an episode about the economy toward the end of President Biden's term. And I think we learned a lot from that one. So I'm going to post the link to that one on the screen for the video so people can go back and watch that. I also don't want to focus so much on tariffs, what they are, how they work. We did another episode about that, so I'm going to post the link to that on the screen as well so people can go watch. But I want to start with this question. We are on a tariff roller coaster right now. President Trump has imposed and removed tariffs unpredictably. What are the immediate consequences, economic consequences of these sudden shifts? Will they benefit us in any way?
I mean, I'll just start with a general thought of markets in general don't like uncertainty. So I don't see it as benefiting stocks in any way or investments in any way, or really the economy in general, because all it does is add uncertainty that people, even if, say, tariffs have a negative impact on the economy, which, most economic studies have tended to show, if it's known what the tariffs are and when they will be enacted, then companies can act accordingly and adjust and, adapt as a result of that. And so even if the tariffs are enacted, the negative impact of those tariffs would be lower as long as they know what the tariffs will be and when they will be enacted. And so the fact that there's uncertainty about what the tariffs will be and when they will be enacted makes it harder for companies to adjust to those, which has I'd say a further negative impact associated with them.
Yeah, I'll just maybe follow up on that. It's not just going to be market reactions, right? If you're a company planning on capital expenditures and thinking about building a new plant or more equipment, things like that, right? You're thinking not just 1 year down the road, you're thinking 3, 4, 5 years down the road and trying to time when the best time to do any type of investment is going to be. And this just, some of it just kind of destroys your plans, right? Well, what would have worked last week might not work this week. So there's going to also be a tendency to delay, right? Delay investment projects or kind of counterproductively, well, should I even be looking at these things within the U.S., right? I mean, the U.S. has what, 5% of the world's population. Should I be looking elsewhere, right? Where I'm not going to be exposed to these uncertainties, right? Uncertainty, like in general in economics, is bad. Rounds of uncertainty, policy uncertainty measures that we see right now are really quite high. They've like tripled in terms of the indexes I've seen, and it's not good for the markets. It's not good for businesses trying to make long-term plans.
Right. I was recently talking to a Trump voter. There are a lot of people who still have a lot of faith in Donald Trump and Elon Musk, and they believe that they are doing the right thing, and these policies are going to benefit the American people at the end. And one of their arguments is that the other countries are applying tariffs on our products, US products, sometimes 50%, even 100%. they're ripping us off. This is not fair. We should do the same to them. How do you respond to that?
Well, I mean, I can start with, I do think there are cases where other countries are imposing higher tariffs than the U.S. is imposing on their imports, right? So it is not completely inaccurate, but and it's kind of a big but, the tariffs that have been proposed or already imposed, in particular on Canada and Mexico, are not reciprocal. So it's not based on that Canada and Mexico have high tariffs on our exports to them, and we're just matching them. As part of the agreement that Trump actually negotiated when, and I think it was 2018, that there are no tariffs in either direction for most products that are imported or exported to and from Mexico and Canada. And so that is not the basis of why these tariffs are being imposed. There are other countries where, sometimes in European countries, there are higher tariffs than the U.S. imposes on them. But for the most part, these tariffs are the initial escalation of what will be, potentially a significant trade war, because once we announce that, say, we're imposing 25% tariffs on Canada, well, they're going to respond tit for tat, right? That we're going to impose at least 25% tariffs on you, and then it could escalate further from that, which has kind of already started to happen. So it is not the basis of the bulk of the tariffs that have already been imposed or proposed by Trump, that it's just to rectify and even out the tariffs that have already been imposed on us.
I'll follow up a little bit. There are going to be winners and losers in any of this type of trade war, right? So industries like, well, steel industry probably will be a short-term winner in this because they get tariffs on Canadian steel or Japanese steel. I forget was it European? I can't even keep track of all the different changes that are happening day to day. So will certain industries benefit? Yes, right? But there will be general costs associated with that. If we go back to like 2017, right, there was another round of tariffs on China and some renegotiations of stuff with like Mexico and Canada. The Chinese tariffs, we look at things like washing machines, they were pretty much most of that tariff was passed along to U.S. consumers as a tax, right? So I mean, when we hear the word tariff, we should be thinking taxes, right? This is a big tax increase. It's quite an enormous tax increase that we're seeing, right? So is a tax increase on different companies that import or export to the U.S. Well, it's actually not that way. It's kind of companies that import stuff into are going to be paying those particular taxes. So
they will pass it on to the consumers.
There'll be a lot of pass through, and companies are going to look for the best way to avoid the taxes, right? Sometimes that's going to be to increase manufacturing in the U.S., but other times it's going to be switched to other countries, right, that still have lower labor costs. U.S. is still the world's second largest manufacturing economy in the world. We've increased almost every year our manufacturing output, but employment has gone way down, and it's not necessarily because of some from globalization, but a lot of it's through automation. Mm-hmm. So if I'm going to we have all these taxes now on stuff that we used to bring in from China, and I want to establish something in the U.S., I'm not hiring a lot of workers. I'm going as automated as I possibly can, right, to do any of this. So the data that I saw, that at least with the 2017 rounds of tariffs, each steel job that we got ended up costing about $500,000, right? So you're in a lot of cases you'd be just better off. It's still a tax, right? You're taxing and redistributing. you're just better, right? We'll just tax everybody and then redistribute it to the certain industries in manufacturing, or borrow money to give to those particular industries that you want to see grow.
Yeah, actually, that was what I was going to ask you because, when I was talking to this Trump voter, one of the other arguments he had was that, yes, we are going to see some inflation. Yes, the prices are going to go up with these tariffs, but we must go through that because that will bring manufacturing back to the United States and support American businesses. So obviously, you don't think so, but I just want to ask that again to maybe AJ. Do you believe these tariffs will bring manufacturing back and maybe lead to an employment boom?
I mean, I guess as a general answer, it's no. And I think, building on what Joe was speaking about, that of course, it's going to create winners and losers. But it's a matter of, are the gains to the winners greater than or less than the cost to the losers? And with tariffs in particular, I mean, there's never a complete consensus, but it's virtually a consensus, as close as you can get. I think that economic studies has shown that the costs associated with tariffs exceed the gains associated with tariffs. And so those costs, if you just consider, say, tariffs on steel and aluminum, because that's already been imposed, and Trump has announced that he's intending to increase and impose it on more countries. And the goal is, well, let's bring back steel jobs into the U.S. And so the steel industry does benefit, the domestic steel industry does benefit as a result. And there will be more employment as a result. And so just based on that, I can understand, like, politically, it looks positive because it's accurate to say that, well, the steel industry benefits and we're bringing some jobs back that would not have existed otherwise. But you can't, or you shouldn't, only focus on the industries that benefit as a result, because there are a lot more industries that are made worse off as a result. And
like
so,
American businesses, right?
Exactly, American producers that rely on steel that are now going to have to pay more. And here's the other thing about it, that it doesn't just increase the price of imported steel. It also increases the price of steel that's produced in the US. And because it's just increasing the price of steel, period. And so it's been shown that the number of jobs from domestic steel intensive industries is about 20 times the number of jobs in domestic steel producing industries, right? And so the number of jobs that are potentially lost as a result of increasing tariffs on steel is much greater than the number of jobs that would be gained as a result. And so if we're just looking at jobs, right, like what's the net impact to jobs in manufacturing, it's actually a negative impact, because there's a lot more jobs, say, in the automotive industry than there are in the steel producing industry in the US. And companies have already announced that they're going to have to increase the price of their cars by multiple $1,000s as a result of these tariffs. And so
I heard it was $12,000.
I mean, it depends on the type
cars.
of car, right? But I think I think Ford pickup trucks have announced, Ford F-150s, which is the top selling pickup truck produced here in the US. They're going to increase the price of, it's going to result in an increase in the price in excess of $10,000, right? So huge, I mean, significant amount, obviously negatively impacts consumers, but it also negatively impacts Ford, a domestic manufacturer, right? That they're not going to sell as many cars as a result of that. And what that's going to do then is reduce the number of employees, manufacturing employees, that Ford employs. And it's not just Ford. Obviously, steel is a very commonly used input by a lot of manufacturers here in the US. And so the number of jobs destroyed as a result of these tariffs are going to be in manufacturing, not just in general. In manufacturing is going to be greater than the number of jobs that are created. And so, in the end, it's like we shouldn't, with any policy change, we shouldn't just look at the benefits. We shouldn't just look at the costs. We shouldn't just consider the industries that benefit as a result. We shouldn't just consider the industries that are worse off as a result. We should consider both and just say, on net, what is the likely impact associated with this policy change? And the fact is that the likely impact is that we'll have less manufacturing jobs in general, not in every industry, but less manufacturing jobs overall as a result of these tariffs, in particular on steel and aluminum.
Yeah, and there's also when we talk trade policy, usually in class, one of the things that also comes up is there's these what are called beggar thy neighbor strategies, right? Your neighbor is a beggar, therefore they'll just take whatever we give them, and that's never true, right? So what you're also going to see is a lot of reciprocal tariffs, like AJ mentioned before, and those reciprocal tariffs might. Right. I mean, a lot of our companies are multinational companies, global companies selling all over the world. So if I'm a company, right, and then I get this reciprocal tariff, I might choose not to locate a business in the US, right, a new manufacturing plant in the US, because now they're going to face export tariffs, right, I shouldn't say export tariffs, right, the other country is going to impose taxes on US, let's say automobiles. And this was so I'll set up shop someplace else, right? I'll set up shop in Thailand or Vietnam, right? Or the EU, because then, right, I can move my capital wherever I want in the world, right? There's lots of labor elsewhere in the world. There's lots of places that I can locate and that might give me better margins. We saw this with Harley Davidson, right? So, okay, with the 2017 tariffs, right, we're going to bring all these manufacturing jobs back, but the reciprocal tariffs were targeted at iconic American industries, right, like Harley Davidson. And what did Harley do, right? They set up shop someplace else. So you also have to factor in, like AJ was saying with the costs, you also have to factor in not just the first part, right, where we oppose tariffs. You have to think strategically about the entire game, right, that's going on. And there could be more losses from this than you initially anticipate.
Yeah, I didn't realize how much steel we use on so many different industries. I mean, from like washing machines, cutlery, and all these other products. And these companies are importing steel at a cheaper price. So now they have to buy it at this much higher price because the cost is going to be higher in the US. And now their prices are going to be higher. They won't be able to sell as much. So, like you said, they're going to lose employment as a result of that. Just to Joe's point earlier, we are not going to see a lot of employment because there's automation, AI, robotics. Even in China, they have factories where they're using these robots, and they don't have a lot of employment there in some of the factories, right? Those are good points. So economists like Jeffrey Sachs argue that free and open trade has historically driven economic growth. And if you look at China, even Russia, they have grown their economies mainly because they became more open and they supported free trade. If the US isolates itself through these protectionist policies, while countries like China, Europe, and Canada are strengthening their own trade agreements, maybe forming their own alliances, could that weaken America's competitiveness? How would that affect America's place in the global market?
I mean, I think it definitely can. A lot still remains to be seen in terms of, I guess, in terms of the nuances based on how much of this is political negotiating tactic that could potentially, just be reduced in the future once it serves its political purposes, versus how much of it is an actual economic strategy, right? And if it is an actual economic strategy that's intended to stay in place long term, at least for the duration of Trump's term, then to me there's little doubt. And I'd say I shouldn't even personalize it. It's that economic research suggests that that it would be significantly damaging to the U.S. economy. And it's not just economic research based on projections; it's based on history, right? That when tariffs are imposed historically, you can look at the impacts in different industries, and it almost universally suggests that it's had a negative impact in terms of every economic indicator, number of jobs, total output, GDP, et cetera. Where the clearest example is 1931, when there were universal tariffs put in place in excess of 25%. And the world responded, right, Sumell, the world responded by also putting tariffs in place against US exports. And that was not a good time in economic history for the US or the world, right? And it wasn't certainly the sole cause of the Great Depression, but it was a significant contributor of the depth of the depression. And so I'm not suggesting in any way that, well, it's going to lead to the same type of thing, but just based on the fact that it was imposed, I believe, in 1931, and then we had the Great Depression for the following 7 or 8 years, right? That there's no doubt that there's a strong relationship between, if we just look at economic growth and free trade, not just in the US, but around the world. Countries that have lower trade barriers grow at faster rates than countries that have higher trade barriers. And countries that have higher trade barriers, grow at lower rates. And so imposing higher trade barriers is not going to be conducive towards US economic growth.
Yeah, I would tend to agree. And I mean, there's of course different magnitudes, right? How much, right? Is it going to collapse our economy? Probably not. Is it going to lead to 1-2% lower economic growth over the next decade? That's probably within the realm of possibility, right? 2% less, 1% less over the course of a decade is a pretty massive amount, right? So yeah, the US is becoming a smaller part of the world as a whole, right? I think we're 5% of the population. We're roughly about 25% of the economy of the world, right? And those projections are long term are going to be down, right? And then in 20, 30 years, we might only be 15% or 10%, right? So, but 95% of potential consumers are not in the US. So if we're going to limit ourselves to 5% of the population, right, that's not trade. I mean, we can go back to maybe even to like Adam Smith, right? Trade is not a zero-sum game, right? It's a net benefit for everybody. I mean, we trade all the time in our lives, right? It's like I shouldn't be doing everything myself, even though it might make me feel good that I do all these things by myself. I can't do it as well. I have constraints on my time, constraints on my resources. Yeah, I think long term, I don't think being very protectionist does does good for an economy. You can also kind of look at the differences. So you can go back and maybe even like Alexander Hamilton in the US, right, with right, mostly free trade, but there's an infant industry argument when you're trying to industrialize for the first time. So we need to protect ourselves so we can do that industrialization. And you saw some of that in the US initially with relatively high tariffs. And we did industrialize quite a bit and quite rapidly, especially during like World War II. That's kind of the big change. You see the infant industry kind of work in Southeast Asia, where you initially have high tariffs, you have export-oriented growth that leads to kind of a boom initially as you grow, and then slowly you scale back subsidies and protection because you don't want a pure domestic industry that can't compete with anybody else in the world, right? You're trying to make a competitive industry that can go up against the rest of the world. So it somewhat worked in Southeast Asia. So Korea, it worked for and other countries, but it was short term, right? Short term protectionism, not long term protectionism, because you had to be really careful about limiting competition and not having competitive industries. You see kind of the opposite happen in a lot of Latin America, like 40, 50s with Peron in Argentina, you have lots of tariffs, right? I mean, Peron, tariffs, and right, import substitution, and that the same idea that, well, we're going to close off the rest of the world so we can make ourselves, right, to benefit import. We're going to substitute all the imports that we have, and I don't think anybody would argue that, right, that type of policy that we saw was beneficial for Argentina during the 20th century, right? And they've kind of lurched between coup and left-wing policies, coup and right-wing policies, left-wing, right-wing. Their current one's kind of more libertarian,
Currently right wing.
right-wing kind of free trade. I don't even know if it's quite free trade, but yeah, slash government spending. Lots of problems in Argentina. But would you rather be Argentina or right going through kind of right with all of those tariffs or some of the Latin American countries? It didn't work out well for them, right? Long-term protectionism led to inefficient industries. There's a lot of patronage. Yeah, long-term, these things generally tend to be more destructive than they are beneficial. At the very beginning, right, did you see some positive economic growth? Yeah, right, because we're doing a lot of import substitution. We can grow these industries fairly quickly. The U.S. also doesn't have infant industries really anymore, right? We're highly developed. We're a frontier economy. And what does this mean? We're also the reserve economy. To move to maybe another point, you'll hear a lot of issues with our trade balance, how we're importing more than we're exporting. I always like to kind of flip that around. And when we talk trade, we talk two different accounts. We talk, right, trade or a current account, but we also talk about capital, right, and movement of capital. We had to pay for our imports somehow, right? And we have an excess number of stuff that we get. And we pay for that, well, with our assets. And people, and basically the rest of the world is saving a ton in the US, right? They buy our bonds, they buy government bonds, they buy stocks, right? So our stock market has been a big beneficiary of our trade imbalances. Our interest rates on government debt have been a big beneficiary of our trade imbalance, right? Because the U.S. is seen as a reserve, right? It's seen as relatively risk-free because it's stable. So it's not like you have to consider both sides, going back to kind of AJ's point, right? You have to think of the winners and losers, right? Yeah, some of our domestic industries have been losers. The steel industry has been a loser with globalization. Sock manufacturers, loser. Garment industry, loser, right? And I could go through a whole bunch of different losers for this. The beneficiaries have been also our asset holders, right? People
But
in the
also the
stock markets
consumers.
and consumers. We get
Yeah.
really cheap. I mean, it's led to price decreases for a lot of consumers. I mean, you still go to Walmart and where's most stuff produced? It's not the U.S. It would be substantially higher if it was produced in the U.S. So again, going back to that point, you can't just consider winners. You have to right, or losers in terms of the trade. You have to consider the whole different aspect, right? Asset markets, bond
Right.
markets, consumers, producers. I think it was like even with consumers, as you mentioned, I think it was like maybe even like Milton Friedman, right? Like you want to talk conservative, right? Chicago school economist, right? Milton Friedman was like, well, I'm all for China helping me buy stuff, right? We're subsidizing my purchase of goods and services. I'm paraphrasing to an extent. He's probably said it more eloquently than I did. But yes, some of our domestic industries are hurt by that. But right, as a consumer, yeah, if China wants to subsidize my purchase of an electrical vehicle, like go for it. That's great for me, right? But it's not good for our domestic auto manufacturers.
Right. And I mean, being in the textile industry, I've worked in the textile industry before, so I know that every country, when they start to become more developed, they actually stop producing garments and get rid of their apparel manufacturing because these are not value-added industries. You can get that done in China and import clothing. I mean, you'll always have a trade deficit in apparel, but that's actually a good thing if you're a developed country. You don't want to deal with those low value added products.
Right.
You want to focus more on, like, for example, iPhones. To AJ's point, whether these tariffs are political or they're serving another purpose. Either way, I feel like the benefits of these tariffs are always mutually exclusive, because when we impose tariffs on other countries, they impose tariffs on ours, and we say we don't want to rely on other countries. But then if we produce everything for just our consumers and they stop buying from us, then if people are not buying iPhones, like, we only have 330 million consumers in the United States, right? But there are 7 billion people in the world, and we are losing all these sales in that sense. So yeah, that is something that I agree with. I do want to ask you about the recession. Trump himself didn't rule out a possibility of a recession in a recent interview. Are these tariffs going to lead to a recession? And I mean, what indicators should we be watching?
Okay, so I mean, get away from, don't call it a tariff right now, just call it a tax, right? So what does a tax do, right? It reduces spending in an economy, right? What are some of the other things, right? Cut government spending. They are proposing other taxes, tax cuts. We don't know what that's going to look like, but in isolation, right? Adding a tariff and just the cut in government spending, right, will reduce GDP in the short run, right? Will it go negative? I don't know yet. Um, I think first quarter was down. I think it was negative. So I suspect we'll be in a technical. We might already probably be in a technical recession, which we generally say is a couple quarters of negative economic growth. So yes, I would say we'll probably have a recession. Whether or not that's long term or not depends on some of the other policies. Um, right, from what I understand, there'll probably be rather significant tax cuts, but also in a way, those look like they're going to have to be deficit financed. I don't see any other ways without substantial cuts in Medicare, Medicaid, Social Security, or military. You just can't do it. You have to basically eliminate the entire federal government outside of those areas if you want to keep those the same. So I suspect they'll be cutting Medicaid, which is aid for poor and elderly, mostly. What I think it's what it, I don't know the exact numbers off the top of my head, but right, some nursing care, child health care programs, those types of things, you'll probably see reductions in. So those things also will reduce overall consumption within an economy. So we're probably looking at, yeah, a recession, at least in the short term. The tax cuts, depending upon how they're done, might mitigate some of that overall effect. And then also from an economy, big picture economic effects, what you find is there's a lot of things that also will adjust to mitigate effects. So yes, we're talking about tariffs, right? But one thing that also happens when we do these broad-based tariffs is it has effects on exchange rates, right? So as we affect the exchange rates, that mitigates some of the overall impact of the tariff, right? So we're probably going to see, I mean, all things else equal, we might see a strengthening of the dollar, which would make other countries' stuff cheaper, reduce our exports, alongside, right? Any change in imports. There's all of these automatic stabilizers that you kind of have to factor in, and it's really hard to predict exactly what's going to happen. I think between the two things, the cuts in government expenditure and the tariffs, right, that increase in tax, right, short term will have a negative effect on the economy. The long term depends upon how big those stabilizers are, what the tax cuts are, what groups they're targeted at. The last set of tax cuts in 2017 were both as a percent and an absolute value much more targeted toward people with low propensities to consume, right? So it led to just increasing asset prices. rather than a lot of additional economic growth. And that looks like the way this is structured again, right? The increase in taxes, an increase in consumption tax on pretty much everybody through tariffs, and then relatively, and then cuts for people with lower propensities to consume. So in those cases, that's not also what we would consider probably to be conducive to economic growth. And then uncertainty on top of that will lower probably investment spending in the short run, until we kind of and people kind of figure out what the new game is, and then kind of what happens from there. I don't know.
Mm-hmm. I would agree with Joe on that, on everything he said. I'd say, it is that we likely are headed to a recession or potentially technically in one. It's just not official yet. I personally don't expect it to be a significant recession, like anything close to, say, the Great Recession from 15 years ago. But that being said, I think the other part that's relevant is a tariff is a tax, right? But it's a sales tax. And sales taxes are regressive, meaning that a higher proportion of it is paid by lower income individuals than by higher income individuals. And that's just the basis of, well, lower income individuals have a higher propensity to consume. They spend a higher proportion of their income because they have lower income. Whereas if you have $1 million, you're not spending $1 million generally each year. And so, these tariffs, which can kind of counterbalance to some degree, not nearly as much as what's been proposed, the loss in revenue from the tax cuts that are being proposed. But the tax cuts that are being proposed are, as Joe said, targeted towards higher income individuals. And so essentially we're replacing sales taxes, which are regressive, in order to fund partially, at least, not nearly close to the total amount, tax cuts which are weighted towards high income individuals, right? And so that also, contributes to further income inequality, which is just another, issue that I think most people think we already have too much income inequality, right? And so it's going to create even more as a result. The other side of it too is, I'm not overly concerned with, whether we technically are in a recession or head to a recession, but what is, I'd say, more of a concern is how inflation will be impacted by these tariffs, and more of a concern in terms of, like, just having a recession. There are mechanisms that take place naturally, some of them, and some of them that can take place through policies, like decreasing interest rates and, fiscal policies, that can mitigate the impact of the recession. But if it's a recession combined with still stubbornly high inflation, well, that makes it a lot harder to address, right? Because just naturally, what the Federal Reserve, they have the twin goals and dual mandate of, keeping us at full employment while keeping inflation low, the benchmark of 2%. And you can't tackle both simultaneously. You just can't, because when you're fighting one, it can exacerbate the other. When you're fighting the other, it makes the other worse. And so, the real concern, I think, and would be that we have a situation where we're technically in a recession and we still have relatively high inflation. And, I'm not expecting anything close to what we were dealing with, say, in the late 1970s, where inflation was, in some cases, in some years, double digits or close to. But even if we have, inflation of above 3% and the economy is declining, well, that just makes it a much more difficult issue to address for policymakers, in particular for the Federal Reserve.
Right. And I mean, when I was talking to this person, the Trump supporter, who was telling me, even if the inflation goes up, we are buying too much anyway, so we should stop buying and we shouldn't buy so much. But I was thinking about people who are already going to be losing their Medicaid and their Social Security. A lot of those people are living paycheck to paycheck. So maybe for somebody rich, buying eggs at $10 a dozen is not going to affect them. But for somebody who can't even make their rent, even though they work 40 hours a week, paying $10 for eggs is going to be very difficult for them. And now they are going to lose food stamps and all other social benefits. And I feel like, it will be impossible for these people to come back from that. And this will be, it will have a catastrophic effect on low-income Americans. But high-income Americans will also enjoy tax cuts, and, they're not going to be affected as much. So this looks like a very unfair consequence and increase the income inequality. One other thing I want to ask you is, if a recession happens, or if we are in a recession already, maybe we are, first of all, should we sell all our stocks?
I mean, I'll say generally no. In general, it's really difficult to time the market and to be overreactive and withdraw anything from, say, an IRA or 401k is a bad idea. Now, it's not necessarily a bad idea to maybe rebalance in some ways and put some more money in safer, less volatile assets like money market accounts. But I would tend to advise, especially younger people, to not pay too close attention to what's happening with stocks, month by month or year by year, because even if it's already down about 10% from its peak just in the last month or so, and it could go down further. I think today it's gone up a bit, but I think the consideration is, are you planning on using any of those, say, retirement funds anytime soon? And for the vast majority, it's like, no, because I'm not retiring anytime soon, right? And so if you're not retiring anytime soon, then don't worry too much about short-term fluctuations in the market, because historically the gains in the rebound exceed the losses during the downturn, right? The gains in the expansionary period are greater than the losses during the recessionary period. And there's no reason to think that would not be true in this case as well, right? And so for those who are closer to retirement, it might make more sense to rebalance a bit, because it could be, potentially sharp downturn in terms of stocks. But if, say, you're at least 20 years or more out from retirement, then I'd say don't sweat the short-term changes much, or base any decisions, and certainly don't withdraw from IRAs and have to potentially incur tax penalties as a result of that.
I'd agree, right? I mean, if you were already close to retirement, I mean, the advice would have been you already should have been in, right, stuff that is more secure and less overall volatile. If you're thinking long term, right, the historic gains have been, I mean, being in stocks versus bonds, it's just been tremendous, right? And it's hard to say, even if our stock market loses a couple percent, right, over the next decade, or we've even had decades like after 2000 where it was really bad from between 2000 and 2007, and right, it's just there's a lost decade of overall growth. You can experience that again, but if you have a really long horizon, right, AJ's point's correct, right, that the gains have outweighed the overall costs. You may want to consider diversifying, right? I mean, we always want to say diversify. Look at the rest of the world, right? Not just the U.S., right? The U.S. stocks are much more expensive than those from the rest of the world. And part of that's because, I mean, if you look at the top companies in the world, where are they all located? Some of it's just by chance, but also some of it's just because, right? California and especially the San Francisco area, right, has been an absolutely incredible place of development of wealth over the past 30 years, 20 years, right? If you're looking at, right, Apple and Google, right? So you still have that, and right, and where are potential gains in the future, um, right? There's still a lot of upside to the U.S., right? Especially because we have some of those great high value companies still. Um, Short term, I'd expect a lot of volatility. I, I
Hmm.
just don't see us getting away from some of the volatility with economic conditions and tariffs. It's uncertainty is just policy uncertainty is going to right add volatility to the markets. But yeah, long term, right? It's usually historically it's been best to stay the course. But if you were already close to retirement, right, it's kind of then yeah, you might want to look at more diversification of your portfolio. And if you can't handle the volatility, right, you should be in overall safer assets that
If
are
we
less
can come
volatile.
back, if we can come back from the recession
Yeah, I think.
in
I mean,
5 years, 10 years, you know.
Mhm.
yeah, I think usually there's a lot of self-regulation that happens in economies. So I could probably paint doomsday scenarios, right,
Hmm.
for people, right? I mean, you could have the Zimbabwe's of the world where you end up with a billion% inflation, right? Or the Venezuelas, right, where you're ending up with hyperinflation. I mean, so could I could I paint a dystopian picture? Yes, I probably could. Do I think that's the likely scenario that we're going to see? I mean, I don't think so. Knock on wood. I
Let's
don't
hope. Yeah.
I
And there's not much you could do to protect yourself from that anyway, right? Because it's like
Right.
if I withdraw all my money and from a say my investments and just keep them in cash, and then there were hyperinflation, I'm even worse off than if I just kept them in the investments, right? And so
Right.
your ability to uh, inure yourself from the doomsday
Hmm.
scenarios is already limited, and I think like I think financial advisor would say is the best way of dealing with risk is
Hmm.
diversification, and so don't have all your money in stocks, don't have all your money in U.S. stocks, spread it around to different, money markets, bonds, stocks, and not just in the U.S. There's, international index funds like Vanguard has a
Hmm.
world index fund that just essentially tracks the overall world, and you could do just
Hmm.
excluding the U.S., developing countries. So there are lots of options out there in terms of increasing the level of
If
diversification.
if we apply these tariffs and then other countries apply reciprocal tariffs, how do you think the global economy will do? I mean, how will that affect the global markets in general? Because I mean, we are a big player in the global trade.
yeah, I mean, I mean, think of it in some ways. Think of it a little like a game, right? What's going to happen is people are going to come up with strategies to protect themselves from the tariffs, right? Or come up with ways to avoid the tariffs, right? Um, and in some cases, it's going to be, well, we'll just not deal with the US, right? The rest of the world's still about 75% of the overall global GDP. We can look elsewhere if it's too expensive to do stuff
Mhm.
um, in the US. So I think there'll be a period of adaptation as people adjust to new realities. Um,
I mean, I was asking in terms of like investing in international index funds and others.
Yeah.
What if they're affected also because of these tariffs?
Well, yeah, and they would be. I mean, the thing is free trade when it's done right. It can and should be a win-win. And so then restricting trade, as we're currently doing, because it always results in the tit for tat scenarios, will be a lose-lose as well. And I think an argument's often that, well, the other countries are going to lose more, and so that's why we're okay. It's like, yeah, but we're still going to lose, maybe just
Right,
not as much.
right.
So, but I think to Joe's point, it's like the tariffs aren't universal, and
Mhm.
they're targeted towards specific countries, and so yeah, it would. There's no doubt. I that it would reduce world growth, but it's not going to reduce world growth evenly. Like all
Right.
countries will suffer the same
Mhm.
rate. So to that point, it's more about just diversification, and it's not to say that's going to protect you from the impact of these tariffs completely, but nothing could. And so the best strategy is to put your money in as many different assets as you can, because in the end, if the whole world economy crashes, well, it's not going to matter anyway, right?
Right.
Like in the
Or we
end,
are
it's like, well,
nuked.
maybe just invest in Campbell's soup and bunkers, and then
Right.
that's the only safe investment.
Or we are in a nuclear apocalypse, then it doesn't really matter, right? We're all gonna die
Yeah,
anyway, so
exactly.
nothing matters. One last question I have. You have heard President Trump blame Biden administration for the price increases and inflation, and I see this all the time in Turkey because the Turkish president usually just blames all the inflation on the opposition party sometimes. And then I'm thinking, you're in power for 20 years. Who else? Who else had a chance to change the economy? And I feel like this is the typical authoritarian playbook that they follow. But I still want to ask you, if a recession happens, would these tariffs be the major cause, or are there deeper economic problems at play?
Yeah, I mean, I would say it's always there's always multiple factors that would be at play, and there's no doubt to me that the tariffs would play a role. How much of a role kind of remains to be seen. And in some cases, it's like even without tariffs, a recession wouldn't necessarily be surprising, just given the natural business cycle, and that we've been in an expansionary period for a number of years now, and stocks were already expensive, and so to have a correction, which we already do, even without tariffs, even though that is the probably the primary cause of the recent downturn in stock prices, wouldn't have been surprising, just given natural like fundamentals, price to earnings ratios and those types of things. So I'd say it's possible that tariffs could be like the impetus, what starts it, but it doesn't mean it's the only or even necessarily the major cause of a recession.
Yeah, I would agree with AJ, right? I mean, you're still looking, right, in that there are lots of causes of recessions, but sometimes a few extra things can mean difference between a slowdown and a recession. So the tariffs, right, the taxes that we're doing on imports, right, they will slow they'll slow economic growth, right? We know that with pretty good certainty, at least in isolation, right? When you impose taxes, right, it's going to slow economic growth. Things like egg prices, right? The major cause of the egg price changes has been bird flu, right? It hasn't been a
Mhm.
lot of other things. I think there's been probably some issues with pricing and monopolies or probably oligopolies and major food or egg producers, but it's something that's outside of most people's control. And I think egg prices are should eventually go down, right? Because as we approach the summer months, I would expect egg prices to go down. Will they go down all the way to the way they used to be? No, probably not. It's still
Well,
going to take.
probably. I mean, if we are firing researchers who are working on bird flu, that's probably not going to help, right?
No, no. And you always worry about other pandemics coming along and other outside forces, or even something like, okay, we're making a lot of bets on AI. Um, maybe it does great, but maybe the benefits aren't concentrated into a few areas. Maybe they're very distributive benefits, and some of the major investments like a Microsoft are making are not going to pan out for Microsoft. They might pan out for society as a whole in the long term, but yeah, Microsoft invests billions of dollars and they don't get a lot of profit for it, right? And then the markets, right? Then there's a period of time afterwards where they just cut a lot of that particular spending, and that reduces economic growth. So there can be a lot of triggers towards these types of recessions. Like 2000 recession was mostly the dot-com bust, right? We had
Mm-hmm.
crazy valuations for companies that had never made money. 2007 was a financial crisis and a balance sheet problem. This time, right? Yeah, it's probably a number of things that could also factor in, right? Um, right, some changing in the structure of the economy. Also, thinking about, right, yeah, tariffs, right, and bird flu and other things.
Mm-hmm. All right. Well, thank you guys so much. I have learned a lot again, and Bertram might want to host you guys separately in another episode, maybe in the next couple of weeks. Let's see how everything goes with the economy, and I will keep in touch with you guys.
Great. Thanks,
So,
Taji.
thank you.